Good afternoon, and thank you for joining us for this installment of Fireside Chats with our founder. Today we have with us Peter Sand, the Chief Analyst over at Xeneta.
Good to meet both of you this fine day, and thanks for the kind invitation to share Xeneta insights with the rest of the world.
Absolutely. Thank you so much for setting the time aside to participate with us today. And of course, we have our founder and CEO, Shalabh Singhal.
Thanks, Nick, and looking forward to this discussion with Peter today.
Fantastic. So we'll jump right into it, gentlemen. And the subject of today's Fireside Chat is freight rate volatility and its impact on global supply chains. And we'll put this first question over to you, Peter, as you are our guest today.
Thanks,
Have freight rates historically been subject to such pricing volatility, or is this a relatively new phenomenon?
I think the aspect of volatility have definitely been around the container shipping industry for forever. It is only at point in times where the market is very flat, as in without a pulse. We should all be worried, either due to the fact that there's massive overcapacity, or there's exactly the opposite in the world. Appallingly poor performance of global economics, making it all too cumbersome for everyone to move goods around the world. I think in hindsight, most recent hindsight, I would say, obviously volatility has been all about the upside of global freight rates, moving from, almost not profitable for the carriers and at many days and years during the past decade or so, to massively profitable freight rates across the board during the pandemic years. That was quite a turnaround from absolute no vicinity into where demand could be in the early days of 2020 to a red hot market. And I think it's fair to say that as we speak now in the early days of 2023, we haven't hit reset button just like that, but spot freight rates at least are back where they were in the pre-pandemic times, and long-term contract rates are likely to follow soon shortly. So volatility going forward will definitely still be very much a risk to manage for everyone selling and procuring freight in the global market. And literally that's where Xeneta is at its best. You just need to focus very much on making sure that volatility can be also seen in the range of $1,000 to $2,000, and not necessarily in the range of $6,000 to $10,000, all per FEU and regardless of what trade. So is it a relatively new phenomenon? No, I would say it's the one factor that everyone have sought out to manage from a risk perspective forever. Going forward, I think it's just more important than ever to get the right insight, use the right tools in order to make yourself the best of the game when procuring and selling freight in the market.
Fantastic. Thank you so much for that insight there. And we'll turn the same question over to you, Shalabh.
Yeah, I think I would largely agree to what Peter said. But just to add my perspective here, I think what we have witnessed in last couple of years since COVID outbreak, I would categorize it as extreme volatility rather than just the plain volatility, where you see freight rates going 5 to 7 times in a year's time, and then a kind of very sharp decline that we see since second quarter of 2022. So I think this kind of volatility has not been seen in the past. And I believe, like with a lot of other things, there is a certain inflection point, and the complexity in supply chain has now reached to that particular inflection point where any particular factor can have ripple effects on the entire network. And I think that is one of the reasons why we see such huge kind of disruptions in the entire supply chain network, or let's say in the freight logistic costs in particular, happening very soon. So I believe that this kind of volatility is the new normal now. It's not kind of something which most businesses have experienced in the past. Yes, there was a volatility, but that was more manageable. But going forward, as Peter also said, I think this is going to be the norm, and this is something which is a very much, I would say, tangible risk which every business in global supply chains have to manage proactively.
Yeah, some interesting observations there, certainly, and we'll have to, see how this one plays out a year from now. And we had touched upon this in your answers there previously, so quite a nice dovetail here. And Peter, what would you say following the pandemic have been other factors that have contributed to freight rate volatility and that we're currently seeing reflected in the market?
I think, Nick, you touch on something interesting here that let's do another stock taking a year from now. Being, say, sitting on the outside of the market, looking inside to the market, not procuring freight myself or my team or as such. I think we only can afford that luxury. Everyone in the market needs to act right here, right now, with the best possible insight available. And I think those factors that you ask for here that are essential for understanding the freight rate volatility going forward is getting a fundamental understanding of what literally drives the market, what drives freight rate. Why do we see freight rates jumping up and down during COVID years or during Chinese Lunar New Year, which is also just upon us in a short while? But those of us with good insights into the market may already have seen it from quite a distance that the market in 2023 is unlikely to be anything like we have seen before, at least the first traditional season, where we often see freight rates going up due to shippers demanding more capacity, shipping goods ahead of the close down in China and Vietnam during the Chinese Lunar New Year weeks. That's cooled off this year. So forget about traditional peaks, at least for the first half of 2023. You need to understand that the markets are mainly driven, of course, by demand. But as at Xeneta, we currently expect that volumes will keep on falling in 2023. And with that as a guiding, say, lantern for the demand side, we turn also to the supply side of the freight rate equation, literally, that of available capacity offered into the market by carriers and freight forwarders. And we must say that if you are a seller of freight in the market right now, then you are also facing a market where you are offering too much into a market that is as opposed to what is being asked and required and demanded for. So when you see congestion, I mean, the long lines of ships waiting to call ports in China, in North Europe, in the US East Coast most recently, when you see that evaporate in front of you, you also see shipping capacity getting fed back into the marketplace, getting that pressure to freight rates instantly. And if we look also at the order book, I mean, a lot of carriers and investors ordered a lot of new ships for this crazy market. And during the hype in 2021 and 2022, those ships will now be delivered in 2023, 2024, and 2025, adding additional pressure to the market. So one of the things that I would encourage you all to watch out for is, of course, how carriers manage the risk of overcapacity, blanking sailings, canceling existing services. Next in line, it will be layups. At first hand, it'll be hot layups, a little bit later, cold layups. And of course, if you cannot avoid it, we'll see outright demolition of capacity. All those tools in that toolbox we expect to be deployed during 2023. So of course, those will be the indicators of the volatility that will be also visible in the freight rates for the coming year. And of course, getting that head around those drivers of volatility it's essential also to understand and position yourself for the important negotiations that you as a shipper always find yourself in when tendering your freight with freight forwarders and shippers, more or less every single month, as it tends to be. At least that's what we see in Xeneta data, that it apparently is tendering season all year round. So that's perhaps a part of the next normal, whenever that dust settles fully on the pandemic. So I'm eager to hear what you think will drive the volatility going forward, Shalabh. How do you see that?
Yeah, I think first of all, excellent points, Peter, that you have made. I think going into 2023, I believe one of the additional factors that would drive volatility is all the new environmental regulations, especially IMO 2023, which I believe is going to somewhere cause upward pressure on the freight rates, right? So, for example, the ship owners need to compliance with all the vessel emission norms. They would have to find alternate fuels or reduce sailing speed to kind of comply with those norms, which is essentially reducing capacity in the market. They might also have to invest in some kind of retrofitting vessels or technology to, or maybe to recycle few vessels, right? Also, I think some of the costs will eventually be passed on to the freight buyers. So, for example, any voyages which are involving EU ports, they might be required to buy carbon credits to stay compliant. So I think that is one factors which I think I would like to watch for. How does that impact the overall freight market? Obviously, with the recessionary pressures and the overall inflation, there is a smoothing of the overall consumer demand. So, which I think already has been in play for last couple of quarters with respect to softening of overall freight rate market, and I think that will kind of continue to happen. But I think outside of this, also the entire carrier industry will be working on several factors to ensure, as you rightly said, for example, blank sailings and all, which will continue to play a role. So I think all the market forces will be trying to play some kind of equilibrium here, but we need to still see which of these forces will have a outlier effect on the overall freight rates.
It's some very interesting observations there, guys. And, you know, what I take away from this is it really seems like it's a double whammy for the carriers, you know, just having a glut of supply on the market, and then also, you know, these increase in overheads as it comes to the regulatory compliance. So I'm sure it's going to be keeping up a lot of people at night. Excellent. Come to our next question, and again, we'll put this over to you, Peter. What are some of the wider ramifications that volatile freight rates are having on global supply chains?
Let me just give you one example of what happened during the COVID years when freight rates went sky high. Obviously, some products that would normally be sold at retailer level with quite low margins were literally squeezed out of the markets because no retailer were capable of passing on the added transportation costs on low margin products. That is, of course, something that will now perhaps be a little bit of a cushion to the freight forwarders and the carriers, that some of those volumes and some of those cargoes will now find their way back to the market, but it's definitely one of the aspects that have also been discussed widely in the past couple of years. Is high freight rates also pushing to the flames of inflation? I've been asked that questions many times over, and I've regularly said that I see your point. I hear you also in the sense that we are now having freight rates at a level not seen before, unlikely to be repeated again, sitting 200, 500% above where they used to. But for many of those high-priced products around the world that often would see a transportation cost per unit down in the 10, 20 cents, perhaps, you would not be able to see exactly the impact of $10,000 per FEU, meaning that the cost for say a sneaker or an electronic device, where the cost would go up to a couple of dollars, $5 perhaps from $1 or 50 cents. So I would say the wider indications that freight rates and logistics costs have pushed to the flames of inflation are definitely overstated. But without doubt, I mean, in the general aspect, it did impact the say the transportation of many low profit or low margin goods out of the market during those times. So they literally left the market, or literally left the retailers without any product at all to offer to their customers. So I would say that was definitely a wide ramification. But going forward, I think we should all embrace the fact that the obstacles of, say, the snarling global supply chains, fortunately, during 2023 will evaporate, most of them. Fingers crossed and all going well. We'll have to see about that. But currently, it seems as if things are normalizing in a tough way and in a harsh backdrop due to the global economic, say, low rate environment or low growth environment, if at all. But I think in terms of having reinstated reliability in global supply chains and predictability, and when can I, as a global shipper, expect my goods to be shipped and arrived at the destination, I think everybody will appreciate that reliability of deliveries will go up from the appallingly low levels of the COVID years.
Very interesting insights there. Shalabh, I'd love to get your take on this.
Yeah, so I think I would also agree that something like inflation is obviously I think freight rates have a huge impact on the inflation that we are seeing now. But I also believe that the extreme kind of volatility which we have seen in last couple of years has caused a lot of businesses, a lot of multinational shippers to factor in the transportation cost in their entire supply chain planning and network design much more deeply, right? So no one can now assume that you have unconstrained distribution or logistics capability, right? What is your product design? How leaner or lighter it needs to be? Whether you are doing offshoring or nearshoring, basically, all of these decisions, including your lean inventory strategy, can you really have the same time supply chain strategy when you know that there is so much of volatility in freight rates, right? So you need to have some kind of transportation factor involved when you are thinking about your safety stock or cycle stock inventory. So and also, like, I think what Peter touched upon regarding the low cost items or lower margins items, I think what it's also causing a fundamental shift at national levels, right? So countries which were largely working on in the global supply chains for low value added items, right? I think their competitive advantage is being eroded just because the freight rates are so volatile. Their margins in those low value added items is kind of going away. So they need to think how they can manufacture more higher value added items to withstand all these freight rate disruptions. Yeah.
Yeah, we'll certainly have to, watch this space, and who knows, maybe this is the death of the discount store.
It could be. I mean, we see news from perhaps major tech companies every day, and right now laying off people. But the likes of some of those Dollar Tree for just naming one with a recognizable name. They have definitely seen a change of what kind of goods they have offered on the shelves. So we're definitely also seeing the importance of logistics being lifted, not only to the awareness of the average Joe out there consuming goods coming from all over the place, but certainly also at sea level of many companies, where all of a sudden they have discussed the logistics costs at the board levels and the management meetings on a regular basis. something they have never done before because it's been fairly insignificant in their cost assessments. So well, that may be one positive take on it. More awareness on what makes the world go round in the end.
Yeah.
Absolutely. And Shalabh, we're building naturally quite on from that last question there. We'll put this one over to you to start with. Do you see, any additional external factors that could further compound some of this freight rate volatility in the short to midterm?
Yeah, so I think, Nick, we already touched upon the environmental regulations, which I believe will be one of the major factors, right? But I think there are other factors in place right now. There are still possibilities of further port congestion owing to certain labor strikes. I think some of them were avoided recently, but there are still chances of a lot of labor strikes in different parts where we are seeing that still settlements have not been achieved. Then currently the industry, like the overall carrier industry, what it's going through, there are chances of more consolidation or concentration of the capacity, right? So that would have an impact on the overall freight rate market. And I think the factors that we talked about, for example, blank sailings, or carriers might choose to retire some of their old vessels, or might delay some of these new vessel capacities to actually hit the market. So I think these are the different factors which obviously would be controlled by some of these carrier lines, but has a huge impact on the freight rates across different trade lanes. Yeah. So would love to hear your thoughts on this, Peter. What do you think would be some of the other factors which should be watched for?
I think no major trend can be ruled out as something that would compound the freight rate volatility in the short to midterm. But I must say that the cards are stacked against a massive recovery in freight rates and profitability for the carriers. But if something should disrupt that basis outlook, I would mention only two things for you here today. I think it would be geopolitics and subsequent impacts from that. We've seen the Russian invasion of Ukraine impacting very much global supply chains, also with not only real operational impact, but certainly also the risk of war in Black Sea and the subsequent sanctions. We see also elevated risk in the Far East around Chinese-Taiwanese relations that can also put a spanner in the wheel of what we would otherwise expect to be, say, fairly smooth sailings when global supply chains are untangled. So definitely something from the geopolitics could set aside our base case for the 2023 outlook. And then, of course, we cannot and should no longer deny any green transition coming from global shippers and coming from global consumers. And that will definitely also represent a significant change when looking at procuring freight on a global scale. So it's not necessarily an issue of paying more for greener transportation, but literally awarding those carriers that are already doing a better job than the rest of the pack. Hopefully that could then inspire someone to embrace the green transition of global logistics and transportations also, as we are also seeking on a global scale to handle the climate changes that are inevitably coming upon us. But I think it's fair to say that it's also a task for everyone to handle and manage that as a risk we should control to the best possible extent. So I think those two elements with say a different aspect or different trend coming from the outside would be my choices for this one.
Yeah, some really interesting points that you raised there, and we'll certainly have to see whether that shift to green and more environmentally sustainable shipping, if positive or negative reinforcement really drives that decision. Excellent. Turn the mic over to you, Shalabh, if there's anything you wanted to build off that as well.
No, I just as I shared my points over there, I think would largely agree with what Peter said. There is already other than the regulations on the green transition, a lot of consumer-led initiatives, a lot of GRI framework or SACB framework imposed initiatives around the transportation cost or the scope 2, scope 3 emissions of the enterprises also. So other than carriers kind of prioritizing this green transition, there is a lot of, I would say, initiative by the multi-country shippers or these exporters, importers in adopting these. And this is definitely going to have a lot of impact on the overall industry. What freight forwarders, what carrier lines are these companies going for? Maybe the cost would not only be a factor when determining these overall transportation decisions. Everyone needs to be compliant with these new environmental norms. So that could have one more, I think, new factor which is becoming increasingly important in 2023 when looking into this overall volatility.
Fantastic. And that rounds us out to our final question. We'll give the mic back over to Peter. And what advice would you give to organizations that are currently being impacted by this? And what steps can be taken to mitigate this risk going forward?
The best advice that I can give right now is pay attention to the insights that Shalabh and I are sharing right here, right now, because it's all a game of staying ahead of the pack, right? People buy our product to benchmark themselves against the opposition, and I guess everybody wants to stay ahead of the game. So if you get your head around the factors that decide the fate of the market going forward, and you understand what really drives the rates up and down, spot rates or long contract rates, then you're ahead of the pack and you're ahead of everyone in the game, because only then you can really and truly manage your risk and those risks that you constantly face. So securing a safety net around your most essential goods on your essential key trade lanes. And then if you have a risk appetite to play around on the spot market with some goods that you may not find equally critical for running your conveyor belt or your assembly lines, or just getting goods to the stores in due time for the next back to school season or holiday season, then you can play real tough ball in the spot market on rates like that. So I think the smart provider and the smart procurement team of freight, and also those that sell freight in the market, will try to get their head solidly around what are the risks to manage. They will then actively make the decisions on back of historic data. They will do data-driven decision making, and on top of that, of course, they will also try to put that human element into it, making sure that they have their heads thoroughly around whatever obstacles that they would at first hate to see return because they saw too much of it during the COVID years. It's definitely measures to take from lessons learned during COVID years. And then going forward, imagining if they could, say, reshape better partnerships with carriers or freight forwarders, they may even have a special new clause put into a long-term contract that makes them perhaps most favored customer. And I mean that in the literal way here, not in the, okay, you are treated as everyone else, and if you want a better treatment, you should pay more. No, I mean this in the best possible way, where you perhaps, in case of a capacity squeeze in one way or the other, it's not foreseeable right now, but one way or the other, perhaps, you should not be the one being hit at first. You should be the one that makes sure that your cargo isn't getting rolled, that your cargo finds its way to its final destination at the agreed time with no further hassle and no further ado. So I think that would be my main takeaway from our call here today, and those words of advice that I would hand anyone asking for it, just like you did right now.
Fantastic. And with that, we'll give the final word to Shalabh to close us out.
Yeah, I think I would second what Peter said. I think paying attention to this particular space, and as you rightly asked, Nick, that this is a kind of a new normal right now, and this acceptance has to be driven inside the organization, right? And once that is there, I think there are two strategies largely, as the freight procurement, which Peter also talked about, and I think the second angle to it is the technology piece, right? So on the freight procurement side, I think, as always advised, one needs to hedge against all the fluctuation by locking in rates through forward contracts or options, right? And I think freight forwarders also kind of need to diversify their port calls to bridge future market dislocations due to limited port capacity, or basically, I think the trends that we are seeing, for example, in US, a lot of import shipments moving towards the eastern ports. Then I think in the freight procurement side itself, just working with multiple carriers, freight forwarders, or modes of transportation to diversify one's risk and have more negotiating power with all these freight providers is kind of important. And how you can leverage intermodal shipping, which can offer cost savings and increase flexibility, is important. Now, coming to the second angle, which is the technology piece, I think it is important to think of developing some kind of a smart digital twin or some kind of a simulation engine which can integrate your data from ERPs, TMS, demand, production planning, and then think about optimizing your freight costs, right? So, as I said, like one doesn't have unlimited distribution or unlimited logistic capacity at disposal. So when you are thinking about all of your supply chain decisions, including this particular factor in designing your supply chain, in your network planning, where do you need to optimize for customer delivery, where do you need to optimize for cost? I think those kind of systems or data that needs to be built for long-term solutions. I think that is the only long-term solution, because maybe since 2022 we have been seeing a decline, but I would assume in the new normal we would continue to see more and more volatility.
Excellent. And what I take away from this is definitely something that needs to be addressed, more proactively than reactively. Hedge your bets, and if you're going to hold firm to your position, make sure you have the capital to stay there. Fantastic. Well, this has been, a very informative discussion today. If, any of our audience has been affected by any of the issues that we've raised, please feel free to reach out to us. There will be links at the bottom of the video. And again, we want to thank Peter for his time and, sharing his knowledge with us today.
Thanks for having me, Shalabh. It's definitely a pleasure, and good job moderating this cozy fireside chat with you, Nick. Thanks a lot for your kind attention also, those of you paying attention to us today. Thank you.
Absolutely. And stay tuned for the next installment.